and welcome to today's webinar hosted by Left Brain Professionals. I'm Steve Bressler, and I'll be your host and moderator today. If you need help at any time, you can email us at support@leftbrainpro.com or use the chat function within the Flow platform. Let's go over a few housekeeping items. Today's webinar is hosted on the Flow platform, and you should see a small toolbar with 4 icons in the upper right-hand corner of your browser window. The first button will mute the audio. The second button will put the webinar into full screen mode. The third button enables the chat and Q&A, and the fourth button will enable the settings. Please enter your content questions into the Q&A panel at any time during the presentation. We'll address as many questions as we can, and use the chat feature to chat with hosts, presenters, and other attendees. Please do not enter your content questions in the chat panel, as they may get lost among other conversations. If you should have any connection or audio issue, please try a couple of the following solutions. Turn off your VPN, test your system prior with the links provided, exit and re-enter the event, try a different browser, connect from your personal PC, phone, or tablet, or contact the Flow support. In order to receive CPE credit for today's presentation, you must respond to 3 of the 4 polling questions. Certificates will generate automatically and will be emailed within 48 hours after completion of the webinar. And a survey will display in your browser at the end of today's webinar. So please take a few moments to answer the questions and provide any feedback. The recording of today's presentation will be available on our YouTube channel, and the link will be included in a follow-up email. So thank you for your attention, and without further delay, I will turn it over to Robert for today's content.
All right, well, good afternoon. Thank you, Steve, for that introduction. Again, my name is Robert Jones. We are here today to talk about labor distribution and payroll journal entries. Thanks for joining us. I'll say again for many of you, I know we have several returning participants. Little quick intro to Left Brain Professionals, who we are and what we do. We are a boutique accounting firm that works only with government contractors. We practice primarily accounting system design, implementation, and audit support. We do a lot of work helping clients achieve adequate or approved accounting systems, indirect rates, strategic pricing, and support various DCAA audits. We also provide monthly support or outsourced accounting, as well as CFO and controller services. You've already met me and Steve, and so I want to dive right into today's content. We've got a lot to talk about. At the end of our hour together, you should be able to describe the labor distribution process, explain key components of payroll journal entries, identify common mistakes with labor distribution and payroll. We do have another webinar. We've actually have several videos on our YouTube channel. So if you haven't checked it out, I recommend that you go ahead and check that out. Obviously, you cannot get any CPE credits for those. You can only get CPE credits for live participation in these webinars. But we do put recordings of all the webinars out there. And so we did one last year on other timekeeping and labor distribution stuff. So a little bit different spin with a little more focus on the timekeeping aspect of that particular webinar. We're going to launch a poll. Give me just a second here to get us started. And Steve, if you want to do that first question.
Do you currently perform labor distribution? Yes, it is automated in our system. Yes, it is manual in Excel. No, not currently. Or what is labor distribution? We'll give about 45 seconds here and allow everyone to respond. And let me Oh, do we need to open the poll?
Nope, it's open. I see we've got 29 people,
Yeah,
30
I
now have
see I'm
voted.
tracking. Okay, it looks like most everyone has already voted, so I'm going to give it about 10 more seconds and we'll go ahead and get back to the content.
All right, let me go back to my slides here. All right, so let's talk about labor distribution. This is probably the number one payroll expense issue that we find when we're dealing with new clients. I describe labor distribution as a three-step process. The first is converting hours into dollars. The second is distributing those dollars across the general ledger. And the third is distributing those dollars across jobs or projects. So we're going to do a little bit of a deep dive into each of those steps. It's important to know that you will need a labor distribution report if you go through a DCA audit. If you haven't already been through one, that's going to be one of the things that they ask for. And so we've given you just a snippet of what a sample of what it looks like here. And you are able to download, if you're not aware, you can download the PDF. You should see a little gray button kind of in the lower left-hand corner of your screen with a little down arrow, and that will let you to download the PDF of all of today's presentation. So I said the first step was converting hours into dollars. So one of the things that we often find with new clients is that they have excellent timekeeping systems and that they're tracking the time by job, certainly for the external, right, for billable client work. Many are doing a pretty decent job for the internal jobs as well. But where we find the issue is when we actually get into the general ledger. So we find that they're not really converting those hours into dollars and doing something else with them. So that first step of converting hours into dollars really is kind of the meat of labor distribution. And those other two steps are really the evidence of that. When we work with a new client and we get a copy of their chart of accounts or the trial balance, and we're looking at the financial information, one of the things I'm always looking for, and again, we'll do a little deeper dive later in the presentation, I'm looking to see, are there multiple labor accounts? That's going to be the indicator to me that they're performing labor distribution. When we don't see that, we know that, hey, we've got an issue here and we're going to have to address it. This concept of converting hours into dollars. So we do have hourly employees or non-exempt employees. Those I say are pretty easy because we simply take their pay rate, we multiply it by the hours that they worked, and that's our conversion of hours into dollars. If they're working overtime, again, we know what their overtime rate is. One of the things that you do need to know is you should be separating the overtime premium portion. So for time and a half, that means the half-time portion for double time. If you have, particularly in California, where we have some clients, but there's could be some other situations where you have double overtime. Again, the premium portion, whether it's a half or a 1x, should be separated out and accounted for separately. It's where when we get into our salary and exempt employees are a little more difficult. And we're going to talk about uncompensated overtime or total time accounting as part of our conversation today. Continuing on to step 2, I said that's distributing those dollars across the GL. And I already indicated, hey, we're looking in the general ledger for accounts. And these are just some examples. You may break these down further. You may have others. But at the very least, we're typically looking for direct labor. We're looking for the paid absences that are part of the fringe pool, because remember, that is labor. So whether it's holiday, PTO, sick, vacation, whether you combine it, whether it's separate, doesn't really matter. Those paid absences are also labor that need to be separated. And you might think that that's straightforward, but you'd be surprised at the number of clients that we encounter that they take all of the labor expense and they put it into one account. They don't even break out, the holiday, sick, vacation kind of stuff. You might have facility labor if you've got a facilities pool, overhead labor, G&A labor. As a subset of G&A, remember that we have bids and proposals and internal research and development. And we need to break those out and report those separately, as well as unallowable labor. Now, probably any one of these topics, like many things that we address here in our webinar series, could turn into full webinars. Obviously, we've got, again, recordings on our YouTube channel for things like unallowable costs. So if you want to know what's involved there, you can check out another video. But for today, just know that unallowable labor is something that you need to be considering and tracking and reporting as well. And then I said that you need to distribute those dollars across the job. So in particular, if I've got direct labor and I've got multiple jobs, then I should have a job status report or a P&L by job or whatever your accounting system calls it. I've got some kind of report that shows me what that direct labor is, and in fact, what all of my direct costs are by job. Again, we've given you a snippet of a sample report here so that you can see. This particular report has 4 jobs on it, and if you notice there, if you come down to that account 4501 direct labor, you see that I have direct labor across all 4 of those jobs. When I get to the total column of that 1.75 million, if I were to pull up the general ledger, this is a demo account that we use. If I were to pull up that the general ledger for that demo account, you would see $0.7 million of direct labor in that account. Let's talk now about total time accounting, otherwise known as uncompensated overtime. This is a bit of a unique topic or issue for government contractors. You can find more details about this in DCAA's Information for Contractors document. I've probably said this on other webinars. It's a great document. If you haven't read it, highly recommend. It's great for owners of the organization, certainly great for the accountants in the organization to read that, to understand what DCAA is looking for, and they go into a fair amount of detail from accounting, timekeeping, payroll, and some other items in there. Total time accounting, or again, uncompensated overtime, it is a critical factor in labor distribution because you can't charge the government more than you pay the employee. So again, when I think back to my hourly versus salaried employees, my hourly employees, if they work 45 hours, I'm going to pay them 40 hours at their base rate. I'm going to pay them 5 hours at their overtime rate. That's going to total up very simple. That's the amount that's going to be included in payroll. That's the amount that's going to be in the general ledger. That's the amount that's going to be in the in my invoices back to the government, right? If they're a direct employee, I'm going to be able to trace that through. I've got a one-to-one relationship, very simple, easy, and straightforward. My salaried employees get a little more difficult because I pay my salary employees, and I've got some examples that I'll show you on the screen here in a little bit. But if I've got a salaried employee that's making $1,600 a week, I'm paying that salary employee $1,600, whether they work 40 or 45 or 50 or 55 hours, they're still getting the same thing. So I can't just take, whatever their, if I take their base salary and I divide it by 40 and I say, well, here's what their, hourly rate is, assuming 40 hours a week. But if they work more than 40 hours a week, I can't take that original amount and multiply it through, because then I'm going to end up recording more cost on the book than what I actually paid the employee. Now, I've got a little note here at the bottom of this slide, because you'll hear some people say, do I really have to deal with total time accounting or this uncompensated overtime? The technical answer is it's not required unless the time in question is material in nature, simply meaning that if you've got a lot of uncompensated overtime, then DCAA is going to say, hey, we're seeing this here. This is an issue. Why aren't you addressing it? If you've got somebody that works over occasionally here and there, and you otherwise are pretty much working 40 hours a week for your salaried employees, probably not an issue. Our general guidance in working with clients is it's best to get in the habit of doing this total time accounting, because as your company grows and you take on more professionals, and you have salary and you get busy at times, you're going to see situations where now employees are all of a sudden working 45, 50 hours a week on average, and that's when it becomes a problem. Total time accounting, there are 3 acceptable methods. And again, you'll find this information in the DCAM. This is from DCAA. So if you go to DCAA's website, Go to DCAM Chapter 6, Section 410. You'll find these three acceptable methods of allocating or the accounting aspect of total time accounting. And again, I'm going to show you some detailed examples here. The first is the adjusted or the effective hourly rate. This is, I would say, the DCA preferred method. They don't say that in the document that that's their preferred method, but we know that that's their preferred method. There's the pro rata allocation or a percentage approach. And then there's the concept of using a standard cost where you charge a standard adjusted hourly rate with the variances from that going into overhead. Let's look at what each of these examples look like. So I said the first method was the adjusted hourly rate. I say that this is mathematically easy. It's often programmed already into your system. So if you're using an accounting system that was designed for government contractors, then it's probably already set up to be doing total time accounting and handling this uncompensated overtime. If you're using QuickBooks or something else, you're probably going to have to do this in Excel with a template. Regardless, the math is pretty simple and straightforward. It's just that you have to do the calculation for each week or each pay period. A little background on my example here. You're going to see some similar numbers across all three examples. So what I'm doing is somebody who makes $1,600 a week, that's $83,200 a year. And you'll see in my little table there that what I'm calling their standard rate, assuming that they were to work 40 hours a week, would be $40 an hour, right? Pretty simple, straightforward. $1,600, 40 hours a week, that's $40 an hour. Now, what happens if they work more than 40 hours in a week? Well, remember that I said we're still only paying them $1,600. So now the week, that they work 50 hours, their new effective hourly rate is $32 an hour. And if they work 55 hours, their new effective rate is $29.09. What that means is then when I do my labor distribution report and I say this person worked these various jobs and I carry that through the process, then when I have somebody, I'm going to use the middle example there where they worked 50 hours and the actual rate is $32. If they worked 10 hours on a job in that week, I'm going to charge $380 to that job, not $400, right? If they only worked 40 hours that week, and they had 10 hours to a specific job, I would charge $400. But they worked 50 hours this week, so their new effective rate is $32 an hour. So 10 hours on that job means $320 to that job. So you can also see that on an individual job from week to week, you likely will be charging a different hourly rate for the same employee because it's going to be based upon the actual hours that they work. And it does need to be all hours. So that means that from their timesheet perspective, when we calculate this, we're looking at direct, indirect, and paid absences in that calculation. Okay, so it's really important that we consider that. We can't say, oh, well, we charge the direct one rate and we charge, when they work overhead or G&A something else. No, we have to look at it and calculate that effective rate across all hours worked. And that means that they need to be reporting all hours worked, okay? You'll see situations where some companies say, oh, we'll just report the first 8 hours. And, if you work overtime, you're still getting the same pay anyway, so don't report anything else. That's not an acceptable answer. They do need to be reporting all hours worked, which is why we use the term total time accounting, right? Total being all. Total time accounting means you need to report all of your time and you need to record all of that from a dollars perspective in this concept of labor distribution. The second approach to dealing with uncompensated overtime in the calculation is the pro rata or the percentage approach. In my example here, you'll see that the person worked 50 hours. There were 3 jobs, and you'll see that they worked 15, 10, and 25 hours respectively across the 3 jobs. If I take that at each of those as a percentage of the total hours worked in the week, you'll see that 15 hours divided by 50 hours in the week is 30%. And if you don't trust me, get out your calculators. And then again, you'll see 30, 20, and 50%. It all adds up. And so now when I multiply that through, for example, let's pick on job 2 in the middle, and 10 is an easy round number. remember that I said, and I'm going to back up for a moment here, their standard rate is $40 an hour, right? If they were only working 40 hours, but they worked 50 hours, so their effective hourly rate for this pay period or this week is $32. So you'll see here's that job for 10 hours. What am I charging through? $320. And if you look at that last column with the dollars, you'll see that all of those do add up to the $1,600 that we did pay the employee for that week. The third approach is standard cost. Now, honestly, I don't have any clients. I don't know of anybody. I've never worked with anybody who takes this approach to doing this, but it is an option. A couple of things that you do need to keep in mind is this does require an annual calculation of a standard cost. You might even have to update that standard if there were significant changes that affected the original calculation. And you need to do monthly reconciliation of the variances. So you can see that there's additional work that goes into this. Some people get a little scared when they start looking at that first thing. Well, I've got to recalculate, if I'm going to do that, this first method back here, and I'm going to calculate an adjusted or an effective hourly rate for each week or each pay period. That sounds like a lot of work. But again, that can be programmed into your system, or even if you use an Excel template, we've got a template. It's going to be available for download to you. I'm going to show you a couple of things about it. It's going to automatically handle that calculation for you. So it's really not that difficult. When we look at this standard cost approach, again, each year you're going to have to calculate a standard. You're going to have to update that and say, well, last year we built a standard assuming they were working 2,600 hours. And now this year the forecast is they're going to work 2,500 hours. So that means now I've got to make an update to that. Again, we've also have to do an update we've got to reconcile those variances on a monthly basis. Same example here in terms of my salary, my $1,600 a week. My estimated annual hours that I used for my standard cost here was 2,496 hours. That's 48 hours a week is what again, for my sample here. So my standard cost for this employee is now $33.33 per hour, okay? So we're going to take that information over to the next slide, and we're going to look at a couple of examples. In month one, and I just used simple 4-week, right, just for a quick example here. In month one, they worked 4 weeks, right? So it's going to be 4 times $1,600, that's $6,400. Across the month, you see that they worked 3 jobs. You can see the hours there that they worked. And I'm multiplying that through the $33.33 per hour. So back up a slide just as a quick reminder. This is how we got there. We took our $83,200. We divided it by the 2,496 estimated annual hours. That gave me my standard cost. I now come over here, I take that $33.33, I multiply it by 60, 40, and 100, and you see, now if I multiply that through, I've actually charged $66.66, right? Because that's what I'm gonna record on the books. But I said, wait a minute, I can't actually charge the government or include in my rates anything different than what I paid the employee. This is a salaried employee. They are exempt from overtime. They only got $6,400. So I have a $266 variance that I got to deal with, right? I'm going to have to book that into overhead and allocate that out. Similar concept for month 2, but you'll see in month 2, they worked a different number of hours. And I apologize, I see my total at the bottom of my month 2 example is off. My apologies for that. But you do see that job 1 and job 3 are different in hours. My dollars are correct. I did validate that. My apologies that the total hours is off slightly there. But you'll see that my total dollars for this month, I actually went under. So again, now I've got another variance that I'm going to have to deal with. So again, just so you can see the example here, if you take this approach of standard cost, you are going to have these variances on a month-to-month basis that are going to have to be reconciled. And you might say, Robert, why do I have to reconcile them on a monthly basis? Well, to be fair, I don't think the regulations say that, but for most of us, we are closing out the books on a monthly basis. And so you probably do want to reconcile these on a monthly basis. And my guess is that if you took the approach, DCAA might, I can't speak for them, they might push you into reconciling this on a monthly basis. But you can also imagine that if you waited till the end of the year to reconcile this, you could see this could really be kind of messy in trying to reconcile this. The other reason I would say you'd want to reconcile this on a monthly basis is if you've got cost type contracts and you're submitting invoices on a monthly basis, then you're going to need to account for these types of variances and potentially even maybe update your rates throughout the year, depending on how big these variances are, right? When we go back and we look at things like COVID happening, you know, if you put together a standard cost and then you go into a situation where you've got a significant upturn or a significant downturn in work, those types of things are going to impact these standard costs and cause you other issues. All right, we've got another poll question. Steve, if you'll give me a moment to launch that, and then you can read it to everybody while I take a quick drink of water.
Which method do you use to calculate uncompensated overtime? Adjusted effective hourly rate, pro rata allocation, standard cost, or we don't calculate uncompensated overtime? Looks like the votes are already rolling in, so we'll give you a couple minutes here, about 10 more seconds, and we'll go ahead and close the poll. We're up to 30 and rising.
All right, I'm going to go ahead and close the poll here and go back to our content. So thank you to everybody for participating in that. All right, I'm going to talk about some other examples here and again, walk you through some templates. If you're using QuickBooks Desktop, you can distribute labor costs. We've got a link there from one of our partners, iCat. It's a tool that works with QuickBooks Desktop. It's a great tool. If you're not familiar with it, recommend that you jump on our calendars, talk to us about it. We can give you a quick 15-minute demo and show you what it does. But one of the tools, and at a high level, what it's doing is your government contract accounting reports and calculations. So it does the indirect rates. And in fact, iCat stands for Indirect Cost Allocation Tool. And so that's part of what it does. But again, if you're using QuickBooks Desktop, you can set up Desktop to perform a labor distribution calculation by running what we call a mock payroll. Most companies are using an external payroll provider, so you might be using Paychex or ADP or Paylocity, some other tool out there, and that's fine. Basically, what you're going to do is you're going to run, again, mock payroll. So you're going to run a payroll again within QuickBooks. It's going to do that labor distribution calculation for you, which is really nice. It's going to post everything. And then you just post a journal entry to record your payroll expenses from your external payroll provider. Not going to go through the finite details of that in here. We don't have time for that in our 1 hour, but I do have a couple of screenshots and walk you through the basic process of what that looks like. Again, the PowerPoint is available for download as a PDF. These links are in there and they will be clickable links for you. So in order to make the mock payroll process work in QuickBooks Desktop, and I do want to make sure that I keep saying desktop, you'll see the D there. QuickBooks Online is a great tool, but it does not offer this functionality. So if you're in online, in order to do the labor distribution stuff that we've been talking about today, you'll have to do that in Excel and do some journal entries. It's not horrible unless you happen to have a long list of employees. And again, the template that we have available will help you with that. But on the screenshot that you see here, you do need to turn on full payroll, and you notice that manual payroll is checked. That's the main thing that you need to be aware of. That's going to be in your company preferences portion under payroll and expenses in the QuickBooks Desktop setup. In your employees, they do need to be set up with payroll items and rates, again, as you see in the example here. And note that there are no taxes or deductions on the right-hand side of the screen. Again, we're not really running payroll. We're not going to export any of this. If you're using Paylocity, ADP, Paycheck, somebody else, we're not going to export any of this data to them. It has nothing to do with W-2s and payroll or anything else. This is strictly to do the labor distribution calculation for you. So again, no need to do taxes or anything in here. We don't care about that from this perspective. All we need is all of the various payroll items and we need a rate. Now you will need, as you see here, if you can look at that, you'll see that there's a direct labor rate, there's a holiday, sick, vacation, there's an overhead labor rate. So basically what you need in QuickBooks in order for this to work is you do need a payroll item for each of that's going to map on a one-to-one basis to each of those. It's going to map to each of those general ledger accounts you have. So if you have, again, direct labor, overhead labor, G&A labor, whatever those labor accounts are, you're going to have a one-to-one relationship between payroll items and those general ledger accounts. And so we'll have to have that set up. Then the other thing is obviously having the time data in QuickBooks. So you will need, whether you're entering timesheets directly into QuickBooks, whether you're using an external tool and importing them. Again, we've got, if you check out the other webinar that I mentioned earlier, it's on our YouTube channel. We talk about some other timekeeping solutions. If you've got questions about timekeeping, maybe you need help selecting a timekeeping solution, again, contact us. We can help you with that. We work with a couple of great partners, one in particular that's designed for government contractors, synchronizes with both QuickBooks Desktop and online, and makes it really easy to do this portion of the labor distribution. You can export the stuff to your payroll as well. But regardless, however you're doing the timekeeping, do need to get the time into QuickBooks, because that's the other piece. If I back up a screen here, I've got the person set up, so I've got their rates in here, but in order to do the calculation, I'm going to have the hours. And you'll notice that the example that I selected here, this person has a salaried rate for most of these items. So QuickBooks is going to look at the total hours and calculate this through and do the correct calculation for you. So if they work 45 hours, it's going to take their salary rate and figure out what it is that it's supposed to be. All right, another polling question. So let me get that one launched here. And that's our third one. You can go for it, Steve.
Were you aware of the ability to perform mock payroll in QuickBooks Desktop? Yes, we already use it. Yes, but not applicable to us. No, but I want to learn more, or we don't use QuickBooks Desktop. Votes are starting to roll in, so we'll give you guys some time to digest that.
And also just a reminder that if you've got questions, don't hesitate to put those questions in the question channel up here. So we will get to those at the end of our time. I do see that a question came through sorry, I mentioned the software. The timekeeping software that we work with is called Our Timesheet. That's HOUR, Our Timesheet. You can find them at ourtimesheet.com. If you're really interested in them, I'd ask that you contact us because we can help get you set up. We've got a great relationship with them. Can do a quick demo with you. Can also help you integrate it to your QuickBooks Online or desktop. You can certainly use it if you're not using QuickBooks. It's a great tool, but it does integrate with those two tools.
And I'm going to go ahead and close the poll. Sorry, Robert, to interrupt you there.
And let me get back to my slides and let's carry on here. All right, the next piece are payroll journal entries. Okay. So payroll journal entries, generally another area where we find a number of issues when we're working with clients. So a lot of what I'm going to be talking about here today is if you're using a third-party payroll. You're on QuickBooks and you're using QuickBooks as payroll and you've got the automatic sync set up where they are, When you process it, it automatically runs the transactions back and forth between your QuickBooks and the payroll information. A little bit of a separate conversation. I will say that sometimes their journal entries are always the best and we have to go clean them up. But I'm going to put that aside for the moment because, again, we find that many people are using a third-party payroll provider anyway. So just keep that in mind that we're not talking about the Intuit or QuickBooks payroll subscription if you're using that within your QuickBooks. All right, so payroll journal entries. Basically, right, what we need to record are the labor costs, the employer taxes, and the processing fees. And I've grouped that at a high level, right? We'll break it down a little bit, but at a high level, when we're recording payroll, we've got to record the labor cost, the employer's taxes, and the processing fees. So what does that entail and what does that begin to look like? If you're using the mock payroll process that we just talked about in the last section within QuickBooks, then number one is already done for you, right? Because it's going to do the labor distribution means I'm taking all those hours, I'm converting them into dollars, I'm distributing those dollars across the general ledger, and I'm distributing those across the jobs, right? Because people are going to input their hours by job. It's going to take that time by job and flow all of that information through. So number one, let me just back up here. Number one on my list here of labor cost is already done. So then what do I need to worry about? I need to worry about number two and number three, which means I need to worry about doing a journal entry to record employer taxes and the processing fees. Now, these do get a little more confusing and difficult if you've got employees who are making contributions towards their healthcare. So now they've got a deduction that's coming back to you. If they have any type of garnishments, and it depends on whether or not the payroll provider is processing those payments for garnishment, whether you're processing them. Similar concept for things like 401k. Sometimes your payroll provider is making that 401k payment on your behalf. Sometimes they're simply withholding the dollars and reverting those dollars back to you, and you're making that. So it's hard to give you a 100% template that's going to work for everybody. Just keep that in mind that if you don't know how to do that and you download the template, you can contact us and we can help you. But those are going to be some of the questions that we need to know. Are your employees contributing again towards healthcare or 401k? Do you have any garnishments? And who is handling those third-party payments? And again, those third-party payments could be retirement, healthcare, other stuff. Are you making those payments, or is the payroll provider? And in some cases, the answer is both, right? Because in some cases, the payroll provider might be making some of those payments, and you as the company might be making some of them. So it can make that journal entry a little bit confusing. And then obviously, again, processing fees. The other reason that I like to see, and I talk about this broken out these three ways, is because this is the way when you're using a third-party provider, this is the way you usually see the money come out of your checking account. It can be kind of confusing, and people will say, well, I process payroll. Why can't they just take one lump sum out of my checking account? Well, I got to agree with you. I think it would make life easier if they would. But our experience across all the major payroll providers is this is the way they do it. They take one deduction out for the net pay portion to your employees. They take one deduction out for the taxes portion, which are both your taxes and the employee's taxes, as a matter of fact. And then they take out another deduction for their processing fee. So usually we see 3 transactions coming out of the checkout when you process payroll. All right. This is a sample of what our template looks like. And so you can see that I've hired all of the people from Disney to work for me here. Basic idea in step number 1 is that I've got to have a list of my employees. I need to know their salaries. Now there's another tab that I didn't have feeding into this for my example, but you're going to have the time data coming into this if you're going to use a manual payroll process. I mean, if you're doing this like in Excel. Again, if you're doing this portion in QuickBooks Desktop, then this kind of goes away. You won't be, if you do the mock payroll in QuickBooks Desktop, you won't be using this portion. If you're not using QuickBooks Desktop or you're not using the mock payroll in there, then you're going to have to do this in Excel and do a journal entry. So that's what these little templates are for. But you'll see that it's the same basic concept, right? I've got a place here that shows what my employees are making. This is calculating an effective rate based upon the total hours. So it's calculating that, validating that I'm not, billing back anything more or different. Step number 2 is I've got a summary of all the hours by employee by job. So if you look down the left, you can see job, and you'll see, like, for example, job 2 is listed twice because 2 different people worked it. It's got the total hours, and then it multiplies that through by that person's rate. So for example, if I were to take 8 hours for Goofy on line 2 and I come over to Goofy, I see the Goofy's effective rate is $46.88. And if I were to take 8 and multiply it by $46.88, I would come out to $375 and so forth. And then number 3, the other chart summarizes by job, right? Because I don't necessarily want to enter a journal entry by employee. I don't need to do that, but I do need to enter a journal entry by job. And so what I would be entering here is this here would be a debit to direct labor, assuming these are all direct jobs, but this would be a debit to a labor account would be more accurate for these 12 jobs. And I would reference that job. Obviously, I would select that from my drop down in QuickBooks when I was doing this journal entry. And then my credit to this is going to be the salaries payable, right? So I'm debiting the labor expense. I'm crediting salaries payable. If you use the mock payroll process in QuickBooks Desktop, it's doing the exact same thing. It's just that it's doing it for you, but it's going to be debiting those accounts based upon those pay types, and then it's going to be crediting salaries payable. So if we've done that part, then what's left to be done? Well, then we actually have to do the payroll journal entry and get that into the system. And so this is an example of what payroll journal entry would look like. And so we've got a bunch of debits and credits. We have to, and again, just as an example here, but you can see this particular one, they have employee medical, dental, and vision deductions that come out. So we've got to account for that. You'll see cash comes out 3 different times: cash net pay, cash for safe harbor, which is their 401k, and cash for the taxes are coming out. Down the left, I've got on my debits, I'm debiting my salaries payable in this particular case, because remember in my previous, when I did this, I was debiting the labor expense and crediting salaries payable. So now when I actually do run payroll through my external payroll provider and I get that report back, right, they took money out of the bank. So I've got to credit cash. That's what we're doing up here. I've got to debit the salaries payable, right? I've got to be able to offset that. And then we're balancing between these two, what they took out and what the salaries payable are, the various employee contributions to stuff, as well as the employer taxes over here. And then you'll see that we've got this buildup that's going to help us identify if there's any variance in my journal entry before I go in to post it. Another piece that I want to talk about here, and I guess we're doing really well on time. I guess I was talking faster than I thought. So hopefully you guys have some questions. You'll put some questions in the Q&A here in a moment. Another piece that I do want to talk about is paid absence. So this wasn't really in the learning objectives, but when I was putting together the content, I said, hey, when we're talking about payroll and labor distribution, one of the related topics, and again, something that we often come across, is the proper accounting and GAAP compliance, right? Generally accepted accounting principles for PTO and related items. I won't go super deep into the some of the legal stuff behind this. It does get a little tricky depending on whether you have PTO as a single type of paid absence, whether you break that out as vacation, sick, holiday. The main factor that you need to consider is, does the employee get the hours? Do they get the money upon termination? So for example, usually, right, the employee earn vacation, and if they terminate and they've got a vacation balance, they get to take that with them if that's the case, that's a liability to the company, and it is supposed to be reported on the balance sheet as a liability. They are earning that each pay period, so the expense for that should also be each pay period. So each pay period, I should have a debit to the expense and a credit to the liability on the balance sheet. When they use the PTO or vacation, in this case, when it's on the balance sheet, then when it's being used, I should be debiting the balance sheet, not debiting the expense. And that's one of the things that we see a lot of companies get wrong is they see, like their paid absence expenses like oh big bump, oh big bump, right? And they have those big bumps like in the summer and at the holidays. Well, the reality is you incurred that expense each month, each pay period, and that's when you should be recognizing it. That's one of the principles of GAAP. We should be recognizing that expense when it was incurred. And that is, again, when it's incurred, because you do owe it to the employee. It does get a little bit different if it's something like sick and they don't take the sick time with them. So if they get a bank of sick hours, but that is not cashed out or paid out, then that's treated a little differently. Many companies have gone to a single PTO pool. So we just have one group of hours we draw from. In that case, usually the whole pool is paid out upon termination. Again, that would be something that maybe your policy says, hey, we retain a certain number. So again, there can be some variances in this. It's hard to cover all of those in a little bit of time here. Main idea I want you to walk away with is that, again, if it's something that you're incurring the expense, then you're supposed to be recognizing it and putting it on the income statement and the offset to the balance sheet, and then doing a reconciliation. And that's what the example here on the screen is. So part of the reconciliation comes into play because the balance, the liability, and the expense for that matter are tied to the employee's pay rate. And the other thing we sometimes see happen is that employers give the pay raises throughout the year, but they forget to go back and update the liability amount on the balance sheet, right? So if an employee is making more, the liability employee is dollars, but the liability to the employee is really hours, right? The employee has 100 hours of PTO, and if they get a pay raise in the middle of the year, then that 100 hours of PTO is now all of a sudden, it's more money for them and it's more of an expense for you, and that needs to be reconciled and recorded properly on the books. So the sample that you see here, you'll see I got my list of employees, I've got their rate. If I'm doing this like on a monthly, I've got what was the beginning balance, what did they earn that month or that pay period, depending on how often you want to run this, they use, what was the ending balance. And then you'll notice that gives me a total dollar amount to the far right, I'm going to take my rate, I'm going to multiply it by their ending balance amount, and that's going to give me a dollar amount. And now with all of my employees, it says, hey, you have a liability to your employees for $1,931.97. On the right for my journal entry, when I look at the general ledger, it says, well, the general ledger, I only have $1,500 recorded in there. Right, I've got $1,500 on the balance sheet. That means, I'm under on my liability of $356. So I need to increase my expense by $356.08 and increase my liability by $356.08 as well. Okay. So really, really important. And again, the other piece of this is in your typing / labor distribution, when you're accounting for this, when employees actually use the PTO, that transaction should be coming off of the balance sheet at the point of use instead of coming off of the income statement. So something that, again, we see a lot of small companies struggle with. I see some good attendee chat here. I'm going to flip over to that in a moment. Hope you guys have some questions. Just want to kind of recap some common mistakes and things that we do see on a regular basis as we work with clients. We often see a generic payroll expense account. Sometimes that payroll expense, we've seen it one lump sum. They've got the labor in there, the employer taxes, the processing fees. I mean, they've got everything all in one thing. So obviously we can't calculate, and I should have said that in the very beginning. If you don't have all of these dollars broken out into the proper categories, then we can't calculate your indirect rates, right? We need to know what direct labor is, overhead labor, G&A labor. We need all the fringe expenses, whether that's the employer taxes, the paid absences, all those things have to be broken out, because if they're not broken out, then we can't calculate, and certainly can't accurately calculate, your indirect rates. We see a lot of weird stuff because people are cash basis and they get confused. And so they just say, oh, well, Paychex took out, $10,000 from my checking account, so I record that as as my payroll expense. Well, that's not really true, because again, that might be the net pay portion, and we really need to record the full amount and offset things by taxes and other stuff. So we got to be careful. Kind of the next bullet goes back to bullet number one. We see people sometimes combining labor and taxes into accounts, very confusing. And then the last bullet point there, this is always an interesting one. We do come across some clients who do expense reimbursement through payroll. I always recommend against this. This is my personal preference. I rather that you do expense reimbursement through AP. And there are a lot of automated tools out there, separate conversation. It's a lot cleaner. It's a lot easier. We see various issues from a timing perspective of reimbursing employees. We see a lot of times where expense reimbursements, because it's coming through payroll, somebody doesn't understand and doesn't read the payroll reports correctly. And now all of a sudden they're recording what were expense reimbursements as labor. And again, you can already see, even before I brought up this topic, there's the potential for a lot of confusion. And now when you add in, doing expense reimbursement through payroll, it's just another layer of confusion. It's possible, and you can do it correctly. It is possible to do it correctly through that process, but it does take a little bit of setup, and you got to make sure, especially like if you have a changeover in personnel, that they understand what that report is doing, and that those expenses get coded to the correct places. All right, we do have our final poll so that everybody can get credit. So let me launch that, and then we will dive into the Q&A.
Okay. How much help do you need with payroll journal entries? A lot. Please hurry. Just the template or none? I've got this under control. Oh, yeah, the votes are coming in quickly, so give it a few more moments here and allow everyone an opportunity to respond. All right, I'm going to give it 10 seconds, then we'll close it up here.
All right, I'm going to go ahead and go back to the slides because we've got a couple more slides, and I saw some discussion here. The template is available, so we do have a labor and payroll journal entry template. It is available on our website. Again, there is a link here. The link will also be in the follow-up email that you'll get either later today or probably tomorrow. We will get those certificates out to you. I apologize. I know we had a couple of hiccups in the past. We've got a system worked out now and worked out the kinks of that. So you'll have those CPE certificates hopefully by tomorrow, as well as the follow-up email with the links. All right, so let me look at this chat here. I see a couple of comments. You would debit the accrued PTO on the balance sheet and credit the PTO expense on the PN. How do you record the actual? Yeah, so let me just clarify again. So high level process. Each pay period, you have employees who are earning PTO, vacation, whatever you call it, however you have it broken out. If it is a liability to the company, meaning that it's payable to the employee upon their departure, then it is a liability to the company. It needs to be reported on the balance sheet. That means each pay period, I'm debiting that expense and I'm crediting the liability on the balance sheet. Then, right, so the employee works multiple pay periods, earns, doesn't take any during that time, earns, all of a sudden takes a week off. When they take that week off, then that is a debit to the balance sheet, right? Because I've already recorded the expense. I don't incur the expense when they take the time off. I incur the expense each pay period. When they take the time off, I'm simply relieving the liability. So at that point, I'm crediting the liability. If employee entered times in the Prime's time system, what is the best way to reconcile the time to ensure proper billing and payment to employees? Great question. So we do have situations where a little bit different topic here, but it's certainly related to timekeeping and stuff. We do have situations where client employees must enter timekeeping in their own internal timekeeping system as well as a prime contractor's timekeeping system. Your ability to see and access information sometimes in that prime contractor system is limited. Part of what I would tell you to do is ask the employees that at the end of the week when they submit their time to print out a copy of what they've submitted to the prime, and then they should have to submit that in some kind of report. Maybe they attach it to their internal timekeeping or something so that somebody can validate, hey, now I've got somebody submits their internal, sorry, I got my tongue tied. Somebody inserts their or submits their internal keeping and they submitted 45 hours, but maybe they only submitted 40 hours to the prime because they did 40 hours of direct work and maybe they had 5 hours of overhead meetings or something else. That's okay, right? The 40 and 45 are not going to match, but that otherwise on their timesheet they've got 40 hours reported to their job, right? So hopefully that makes sense in there. And I think I've probably confused myself and a couple of people talking about the journal entries here. Yeah, so, well, in theory, remember when we're talking about posting PTO or something. So at a high level, remember that if I were, if somebody had, let's say somebody took the entire week off, they took 40 hours off for this week and I paid them. And for simple sake, we have one employee. When I said we're going to debit the liability, well, remember, I'm going to have a debit and a credit, right? So I've got a transaction. Somebody worked 40 hours. Let's say it's $1,000. I'm $1,000 this week. What are the debits and credits? The credit is really simple. The credit is cash, right? Credit is, I had to give them $1,000. So my credit is cash. And that part, I think we all can agree, pretty simple and straightforward. Yes. I know you guys can't raise your hand at me, but I'm paying somebody $1,000 cash. So I've got to credit my cash account. So then I'm sitting here saying, okay, well, now I've got to balance this. I got to debit it. So what am I going to debit? And what I'm saying is that you're going to debit the balance sheet because you already have incurred the expense, assuming you did it correctly. All those pay periods that they didn't take PTO, they earned PTO, and you should have been debiting the expense and crediting the liability. Now at the point that they use the PTO, I'm debiting the liability and I'm crediting cash because I had to hand them $1,000 cash, right? Hopefully that cleared things up for everybody. All right, I know we're at the end of our time together. I do want to say thank you. I've got a couple other quick slides here. You can also, you'll be able to access this information on our website. I see Ginger's got one more question, so if you get that in there quickly while I'm talking here, I'll try to get to it here. You can access this presentation. The recording will be available through this website as well as through our website. It'll be on our YouTube channel. You can find us on social media. You can always email us with any questions, support@leftbrainpro.com. And hopefully you'll sign up for some additional webinars. We've got several more coming up. You can find us on our website. So Ginger says, do you ever credit the expense account? And the answer is you might have to as part of that reconciliation, right? Let me just go back to that really quickly to answer her question. If I go back to my slides, when you do this reconciliation at the end of the month, somebody could have posted something wrong. Somebody got paid out, maybe had an employee terminate, and maybe they were terminated for cause and they weren't allowed to take their PTO with them because they were terminated for cause. There could be some other reasons why these things get out of whack. Again, pay rate variances. Somebody might get a pay rate increase and maybe you actually paid that out, but you forgot to update it on here. again, there you can see where there are different things that happen through the timekeeping payroll type of stuff where this gets out of whack, which is why we recommend reconciling this on a monthly basis. And you can see that, here I might be crediting, I might be debiting. It just depends on what that reconciliation is. So hopefully that answered it. Thank you to Ashok for the great presentation. I do appreciate it. I thank you for your time, and everybody have a great day, and hopefully we'll see you again next month.